In this course, we are going to tackle auditing. More specifically, financial statement auditing. Let's get started with what we mean by an audit. Take these financial statements. If you look at the front of most financial statements, particularly those of a publicly listed company for which an audit is required, you will find a report called the Auditor's Report. In later lessons, we'll get into what the report is telling the reader and the basis of the opinion. At this point, realize that an audit is an independent opinion over all the financial information and disclosures that follow throughout the rest of the financial statements. Basically, the audit opinion says that the financial information contained within the financial statements is pretty much accurate and prepared in accordance with the defined criteria. And because it's an opinion of someone other than the company who issues the financial statements, hopefully the readers who use these financial statements feel just a little better knowing that someone else is checking the numbers. That's auditing in a nutshell. Audits are necessary because readers of financial statements need to rely on this information to make decisions. For instance, banks use this information to extend credit. Investors use this information to invest in the company. Governments use this financial information to levy taxes. In the absence of an audit, questions would arise about the relevance and reliability of the information being presented. This is what we call information risk, and it's the risk that the financial statements are inaccurate. Users would otherwise have to worry about such things as the information that hasn't been disclosed, the bias and the motives of management, the sheer mass of the information contained, and the complexity of the information. So instead of having management deal directly with the users on an individual basis, it's generally accepted that having an independent party give an opinion on the financial statements is sufficient. Let's identify the components of an audit. After all, not just anyone can slap one of these audit reports on the set of financial statements. First, you need something to audit, in this case a set of financial statements. But behind these financial statements, you need to recognize that there are likely thousands, millions, or possibly billions of transactions. Financial statements are a summary of all the business activity that goes on during a period and a snapshot of all the entity's assets and liabilities as at the year-end date. This information is compiled by management, not the auditors. Auditors are usually professional accountants, like chartered accountants or certified professional accountants, but they do not prepare the financial information. To do so would impair their objectivity. That is, their appearance of being unbiased. The second component of an audit is that we need criteria against which we can evaluate the information. If management were free to make the rules about the accounting policies, readers would have one heck of a time understanding what it is they are reading. So in the case of a financial statement audit, the criteria is normally generally accepted accounting principles. However, different types of audits can have different criteria. So don't think of criteria in a narrow sense. For example, tax auditors have the tax rules and regulations. Internal auditors have the company's policies and procedures to use as their criteria. And external auditors may be engaged to express an opinion on criteria other than generally accepted accounting principles, such as compliance with a loan agreement. The third component of an audit is the auditor needs something to support their opinion. Every single number, every disclosure, every policy you read in a set of financial statements must be evaluated, tested, and supported. The same way a legal prosecutor gathers evidence to build a case against the defendant, the auditors build a case to support or refute management's presentation of the financial information. We will spend a number of lessons on how this is done most efficiently. An auditor does not look at every single piece of evidence or electronic file in the organization. To do so is impractical and cost prohibitive. The fourth component of an audit is the auditors themselves. These people are not just smucks we pull off the street. Auditors need a deep background in accounting. Auditors need training in audit approaches. And auditors need savvy professional judgment and keen skepticism. Public accounting is a regulated industry. Only licensed public accountants can issue audit opinions. The last element of auditing is reporting. The auditors need a way of expressing their opinion. They need a way of disclosing their findings in a way that is meaningful to the readers. These aren't random words written in a free-form report. Audit reports use very specific language so as to not mislead the readers to over or under rely on the findings presented. So where does confusion exist? Well, make sure you keep the distinction between the auditing and the accounting straight in your mind. Accounting is record keeping. It's the preparation of financial statements. It's the selection of accounting policies. And it's a management responsibility. Auditors are also called professional accountants, but only in rare circumstances do they actually do accounting. Their role is to check that the accounting was done right by management. Next, let's spend a few moments discussing the assurance services provided by public accountants, as these can vary. We will primarily talk most about the financial statement audit in this course. A review engagement is similar, only it provides readers with less assurance because the auditor does less work to support its opinion. A compilation engagement provides no assurance, even though the public accountant is involved in assembling the financial information. This is an example where the public accountants do provide accounting services. However, note that they don't simultaneously provide an opinion. To do so would be a conflict of interest to express an opinion on financial information on which they had a hand in preparing. Other types of audits include such things as reports on the effectiveness of internal controls over financial reporting. This is a common engagement in the United States for publicly listed companies that must comply with the Sarbanes-Oxley Act. Public accounting firms are still thanking Enron for that little piece of legislation. Of course, I'm just kidding. You get used to my cynical perspective after a while. Another type of attestation service, which in my mind is the same thing as assurance, has to do with information technology. Think about the rise of the internet and the electronic commerce. When you go to type your credit card information into a website, don't you worry about the number being stolen? Attestation services like WebTrust and SysTrust and Trustee and others help to give you comfort that someone independent has validated that this website is safe. And before we close, let's just give a shout out to the other types of auditors you may come across or may want to become during your career. Internal auditors are employed by the companies themselves. Internal auditors do similar sorts of activities to external auditors, but their mandate is often broader. Their role is to evaluate the efficiency and effectiveness of all operations inside the company, and not just those solely pertaining to financial reporting. This is called operational auditing. They too strive to maintain independence and often report their findings directly to the audit committee of the board of directors, so that senior executives have less of an ability to sway the auditor's findings. Next, we have those auditors that work in government. These folks may work for the Office of the Auditor General and perform audits on various government departments and entities. Their findings are reported to the government legislature and ensure public accountability. They may do both financial statement auditing work, like the external auditors working at the public accounting firms, as well as operational auditing work like the internal auditors that we just spoke of. There's another group of government auditors that work for the tax departments. And these folks audit taxpayers, which may be individuals or business entities, to make sure that everyone is paying the right amount of taxes. I'm really excited to have you taking this course with me. I've spent 7 years working in public accounting and have taught auditing to students for almost 2 decades. I also have extensive experience working with auditors from the management and board perspective. So hopefully through the lessons and experiences I share with you in the lessons to come, I want to get you excited about the field of auditing. And I only say that half jokingly because for many the world of audit naturally holds a negative connotation. I want to tell you how auditing can be a rewarding short or long-term career choice. The upside of auditing is getting to work in teams, seeing different businesses, traveling and working in different locations. The knock against auditing is that the work can be highly technical in some areas and routine and somewhat mundane in others. Many professional accountants working in the government and industry have a public accounting background, and the majority of these people look back at their public accounting experience as an asset for their business career, regardless of where their aspirations lie. So keep that in mind as we work through this course, and I will try to illustrate and give examples of how the audit principles that you learn in this course are applicable not only in public accounting, but in industry and government careers as well. So there you have it. Auditing landscape, including the need for audits, the type of audits, and the types of auditors. Until next time, don't stop till you get to the top. When you get to the top, don't stop.